Silver is doing something dangerous right now, not because it's going up, but because it's not coming down. We're trading in the low 90s, sitting near all-time record territory, after a vertical push that normally would have triggered profit-taking, position squaring, and liquidation pressure. And none of that is happening. Price is stuck near the highs. That refusal is the tell. If you're holding silver, stacking physical, or just watching this market trying to time an entry, this pattern matters. Because what happens next isn't about headlines or hype. It's about mechanics most people won't see until it's too late. You're watching this now. That already puts you ahead of the crowd, still waiting for confirmation. Your job here isn't to predict where price goes next. It's to understand what's happening underneath so you don't get shaken out or trapped in. I want to walk you through what to watch, how to read it, and why these highs are different. Most people won't notice until it's obvious. Before we go deeper, quick note. If this kind of pattern breakdown is useful, hit subscribe. We don't chase headlines here. We read the tape together. We look for signals before they turn into news. That's the edge. All right, here's what actually happened. Silver ripped from the mid-80s into the low 90s in a matter of days, pushing right up against record highs. Historically, that kind of move gets sold. Fast money takes profit. Weak hands get shaken. Price gives back 30, 40, sometimes 50% of the gain. That's not what we're seeing. Instead, price is consolidating near the highs, tight ranges. Sellers show up, but they can't press it lower. Buyers absorb every dip before it can build momentum. That's not normal rally behavior. When a market refuses to pull back after going vertical, something underneath is supporting it. Either supply is constrained, or holders are refusing to sell, or both. And here's the layer most people miss. Lease rates have been creeping higher. Physical premiums aren't collapsing the way they usually do after a big move. Inventories at COMEX and LBMA aren't rebuilding the way skeptics expected. And positioning data shows commercial hedgers and funds are no longer lined up the way they usually are near cycle peaks. That divergence is the smoke. The fire is what happens when physical tightness collides with stress in the paper market. Let me name the first mechanism plainly. This is the refusal pullback. Here's how it works. Price surges. Everyone expects a retracement. Sellers step in to fade the move, but the market doesn't absorb that supply. Instead, it chops sideways or drifts only slightly lower. Sellers can't build momentum. The pressure release everyone's waiting for never comes. It's like a valve that should open to release steam, and doesn't. That refusal tells you something shifted. Either the participants who normally provide liquidity on the sell side are constrained, or new buyers are stepping in with size every time price dips. You see this pattern across commodity cycles, not just in silver, in oil, in copper, in grains, even in bonds during stress events. The setup is always the same. Vertical move, pause near highs, failure to retrace. And it repeats because participants are conditioned. Years of mean reversion taught them to buy dips and sell rips. Fade the extremes. When that behavior runs into a market that refuses to cooperate, confusion sets in. Confusion delays action. And that delay allows the underlying condition, tight supply, forced holding, structural demand, to persist longer than it should. Silver is sitting right in that pocket. We ran hard. We paused. And sellers aren't getting traction. When a market refuses to give you the pullback you're waiting for, it's telling you the structure changed. That's not a command to chase it. It's not a guarantee it can't reverse. It's information. It's price communicating what's happening beneath the surface. Now, layer in the second mechanism, the physical first squeeze. This one shows up most clearly in metals, but it exists anywhere delivery matters. Physical markets tighten first. You see it in longer delivery times, higher premiums, slower inventory turnover. The paper market, futures, ETFs, derivatives, lags that stress by days or weeks. Then it catches up. And when it does, the move is sharp because paper traders are suddenly pricing in a condition that's already been building quietly in the physical world. That's what we're seeing now. Retail premiums haven't collapsed. Wholesale spreads are sticky. Warehouse stocks aren't rebuilding the way they usually do after a surge. Lease rates, the cost to borrow physical metal, are creeping higher. Those things happen before price explodes or before consolidation forces repositioning. Think about it from the perspective of an industrial user or refiner. If sourcing material takes longer or costs more, you don't wait. You forward buy, you lock in supply. That behavior doesn't make headlines, but it shows up in spreads, lease rates, and small frictions most people ignore. By the time the paper market reprices, the physical market has already moved. That lag is the squeeze. And this is where people ask the wrong question. Everyone wants to know if silver is expensive. That's the wrong lens. The right question is whether it's tight. Expensive means stretched and vulnerable to mean reversion. Tight means constrained supply, sticky positioning, and structural support. Expensive gets sold, tight gets rationed, by price moving higher or by time grinding sideways. We don't know which one we get yet, but the signals will tell us. Here's how these two mechanisms connect. When physical markets tighten, holders behave differently. If you're sitting on inventory and premiums are holding or rising, and replacement material is harder to source, you don't rush to sell into strength. You wait. Sometimes you even add. That behavior creates the refusal pullback. Now, look at the commercial side. Many producers hedge silver as a byproduct of mining something else. Normally, they short futures to lock in revenue. But when lease rates rise and physical availability is uncertain, that calculus changes. Hedging gets delayed. Shorts don't get layered in as aggressively. That shows up in positioning as reduced commercial short pressure. On the other side, you've got funds, trend followers trained to fade commodity strength because mean reversion worked for years. Normally, commercials and funds oppose each other cleanly. Commercials short near peaks, funds long, then funds get squeezed out when commercials cover. But when commercials aren't pressing the short side, the balance breaks. Funds don't have the same counterparty. That imbalance creates fragility. Now add inventory behavior. Earlier in the cycle, we saw drawdowns at COMEX and LBMA. Some metal moved into ETFs, some into private hands, some into industrial pipelines. When price surged, the expectation was that higher prices would pull metal back into warehouses. Sellers would deliver into strength. Supplies would normalize. That's not happening fast enough. Slow restocking tells you one of two things. Either holders don't believe the rally is over, or the metal that left warehouses isn't easily mobilized. Both lean bullish. But here's the trap. This setup can unwind quickly if physical premiums collapse or a large holder decides to liquidate into the bid. Markets don't top on excitement. They top when pressure disappears, when lease rates fall, when premiums normalize, when inventory builds again. We're not there yet. This is the part of the cycle where people make the wrong decision for the right reason. They see price near record highs and think they should take profit. Reasonable, but dangerous if the structure is still tight. Or they see refusal to pull back and decide to chase. Also reasonable, but risky if tightness is already priced in and begins to ease. Both mistakes come from watching the wrong signals. You can't know what happens next. No one can. What you can do is watch structure and understand what each signal says about supply, positioning, and behavior. That's the difference between reacting and responding. So, here's the tension. Do you chase? Do you sell? Do you wait? The answer depends entirely on what you're watching. If you're only tracking headlines and price, you're blind. If you're watching physical flows, positioning, and inventory behavior, you're seeing the structure. And structure tells you where the risk actually lives. Silver doesn't need to go higher from here to be dangerous. It just needs to stay tight. If sellers can't push it lower, time works against anyone waiting for the perfect entry. That's the setup. From here, there are three broad paths. One is a breakout. Price holds these levels, builds energy, then pushes through prior highs. Lease rates spike, premiums widen, inventory drains accelerate. That's the squeeze scenario. One is consolidation. Price chops sideways for weeks. Volatility compresses. Premiums stay firm but don't explode. Inventory stays flat. Time does the rationing. The third is rejection. Something breaks the tightness. Premiums fall, lease rates ease, inventory rebuilds, price retraces sharply and resets. I don't know which one we get, but I can watch the signals that tell me which path is unfolding. Here's what I'm tracking. First, front month versus deferred spreads. In a normal market, future months trade above spot. Is contango. When near-term contracts trade at a premium, that backwardation signals immediate demand. If that front month strength widens, stress is building. If it normalizes, pressure is easing. Second, warehouse inventory flows. I'm not focused on one-day spikes. I'm watching sustained trends over weeks. Persistent outflows matter more than dramatic headlines. Third, retail and wholesale premiums. After big price moves, premiums usually collapse. If they stay sticky, tightness is real. If they compress, that's a warning. Fourth, daily closes relative to highs. Closing near the highs signals acceptance. Fading into the close signals distribution. Fifth, fund positioning from the CFTC. I'm watching whether funds keep adding or hesitate, and whether commercials step back into heavy shorts. No single signal matters alone. It's the cluster that tells the story. Your approach depends on your role. Traders need to respect volatility and avoid chasing without confirmation. Stackers need to accept price movement and think in cycles. Anyone waiting for a pullback needs to define what actually changes the structure. Know your plan before the move happens, because this market will get volatile. And when it does, the people who survive aren't the ones with the best price targets. They're the ones who understood the structure going in. That's what this comes down to. Markets reward people who watch what's happening, not what they hope happens. Silver is showing a refusal pattern, physical tightness, and positioning divergence. That doesn't guarantee higher prices. It does mean the game is different than it was a few months ago. If you're watching spreads, inventory, premiums, and positioning instead of noise, you're already ahead. Edges aren't about being right every time. They're about seeing the game before most people realize it's being played. The crowd will notice silver at extreme prices or after a crash. They'll react then. You don't have to. You can watch the pressure build or fade and make decisions based on structure, not emotion. That's what we do here. If you've traded through a squeeze before, metals, oil, grains, share what you learned. What signals mattered, what you missed. And remember this, silver doesn't top on excitement. It tops when pressure disappears. We're not there yet, but we're watching for it. Stay sharp, watch the signals, and don't let the crowd decide for you. I'll see you in the next one.